to navigate over to the PowerOptions suite of tools, and that's what we're going to use, of course, to illustrate our examples today for the questions that come in. So, perfect. There we go. All right. So our first question looks like it comes in from Arvind, and he wants to know, he has two questions. Last week he sold GRO 10 contract for 5 points, and the expiration is today. And now the closing price is 588. What will happen to your option? Okay, so I'm assuming it's a call. It's a call. Okay, so let's say GROW. Actually, let's just go to the custom spread tool. What you're seeing, of course, is the main PowerOptions suite of tools, the tab navigation system. We're going to go to custom spreads. We're going to build this on the fly, GROW. Now, what's left out of this, Arvind, is that is this just a naked call or is it a covered call? Okay, let's just look at Grow today, the December 5 strike, and you sold 10 contracts of this position. And your premium, you did mention 10 contract for 5 strikes. You didn't mention the premium. Okay, so, all right, so fine. I'll just put in maybe 0.45 cents or so. All right, so this strategy, just selling the call, is a naked call position, has infinite risk to the upside on that position. Oh, there we go. Okay, let's see here. I was scrolling down to see there. Oh, it's a naked call. Okay, so what happened at expiration? Now, naturally, a call position, a call option, if you buy a call, it gives you the right to buy shares of stock at that strike price, and you pay a premium. When you sell a naked call, you have an obligation to deliver shares of stock at this strike price. If you don't own the stock, as it was sold as a naked position, okay, what's going to happen is, come Monday morning, you're going to end up being short shares of stock. You still have to cover the obligation to deliver shares of stock you don't own by your broker. So you're going to be short 1,000 shares of GROW at a premium of $5. And if the market's still trading at 582 or 588, it would cost you essentially 82 cents to close that position. Your gain or loss would now be, if you close the short, your gain or loss would now be whatever you received up front. I put in 45 cents. So it would be the 82 to close the position minus the 45 premium in. You'd be looking at a total loss of 37 cents or $370 for 10 contracts. That's assuming you can close it. Now, if you're in a specific account where you're not allowed to be short stock, your broker might automatically close it for you over the weekend. I'll be honest with you, that happened once to me. I was in a bear call credit spread, and I thought my expiration was the standard expiration, but it was actually the week before. I had entered it wrong in my broker, and I didn't realize it. I entered in the PowerOptions portfolio the way I thought I did it, but I entered it in my broker incorrectly. And sure enough, it was between the strike prices of the bear call credit spread. So I may have sold the 5 strike and bought the 7. Well, the 7 still expired worthless. Stock's trading in this range, so I ended up being short shares of stock. It was actually at $62, $62.50. But it was in an IRA account where I could trade bear calls, but I couldn't be short stock. So they just closed it out for me and then gave me a warning that I have to pay more attention. So that's what can happen. Remember, even if you're in a spread, if you're in a bear call or a bull put, you did not change the obligation of being short an option or being long an option as well. Okay, but if you were allowed to have a naked call in your portfolio, you're probably up at level 4 trading to begin with, so they probably allowed you to be short the position as is. So you will probably be short 1,000 shares of GROW come Monday morning at a price of $5. Okay, now Arvin's follow-up is, can I buy an ex-dividend date a day before share and then sell on the ex-dividend date? Do I get the full dividend or no? As far as I know, it is best not to sell it on the ex-dividend date, okay? So if we have a stock that's paying a dividend on Tuesday, I could buy it on Monday, then come Tuesday at the ex-dividend date, I am on record on holding the stock and getting paid the dividend on Tuesday. Now, the dividend won't come out for another 3 to 4 weeks, depending on how long it takes to process the paperwork and the payment and so forth. But I could close it that week. I could close it on Wednesday, and I'd still receive the dividend 3 to 4 weeks later. The reason I say that I wouldn't close it on the ex-dividend date is that I did notice we had an issue a couple of weeks ago with a customer who was assigned early. It was during a webinar. They were assigned early on a short call position, I believe. It was part of a collar, if I'm not mistaken. And they got assigned on the short call. No, it was I'm sorry, it was a bull call. It was a calendar spread. I apologize. It was a diagonal calendar spread. They were assigned on the short call on the ex-dividend date, which was slightly in the money. Their broker did not automatically exercise the leap call, this 5 months out, to cover the short. So here's the kicker. He got assigned early on the call, which ended up being short shares of stock because he didn't own the stock as a covered call, and the broker didn't automatically exercise the long option because it was a different expiration. So now he ended up being short shares of stock on ex-dividend date and had to pay the dividend. And he saw the dividend come out of his account on his short stock was opened at 9:30 in the morning, and he says by records he saw the dividend come out at 12:45. Why am I going through that description to answer your question? It's because I didn't really realize myself until I was having a conversation with this customer that the actual ex-dividend, well, we know the ex-dividend date, but the ex-dividend time could be at 10 in the morning, 10:30, 11, 11:45, 12. You don't really know what time it is unless you go to probably investor relations for that particular company, tell them you're a shareholder, and ask them what time the dividend is, the ex-dividend actual time during the day. This is why I hesitate to tell you to sell the stock on the ex-dividend date, because in this situation, based on what his broker showed him, that he had to pay out the dividend on the ex-dividend time, which was 12:45 that Friday. If you had bought the stock on Monday, ex-dividend was Tuesday, you sold it at 10 a.m. on Tuesday, but the dividend time was 12:45, the actual exit date was 12:45, you might not have been on record of holding the stock to get the dividend payment. So leave it open through ex-dividend date just to make sure and close it the next day. All right, so let's scroll down to the very bottom of the questions, and I want to see if there's follow-up questions there or comments on that, okay? Okay, let's see here. Let's go this way. Okay. Yeah, Arvine mentioned he is level 4, and Sam said that you have to have 100,000 in your account, of course. And Sam also adds in that you have to have $100,000 in your account as well. I just want to see if there was anything else. Okay, so we've got questions coming up from Mark, John, William, and Sam, of course, started off the conversation a little while ago. He's been following the rally great. He sent me some trades that he's been making. Verizon and Snap was last week, and of course he's been on Roku heavily here as well. All right, William, I'm going to address this question based on one of my, no, I'm not going to do that position. I'm going to do it on AMAT. So William wants to know about short strangle adjustments. Okay, so I'm going to go to AMAT. I had a good move today, but of course it's still down from where I originally got in as a protected position, but I only have a max risk of 4%. Let's go to next week. And, the stock did move up today. It moved up about $1.50. So we're going to enter in a short strangle by selling the 50. I'll sell the 52. Let me clear that out, William. We'll do the 52 for next week. Let's say we opened this a week ago. We did a 52 and the 48. Okay? And let's say we got 35 cents when the stock was at around 50.80. And on the 48, let's say we got another 25 cents or 30 cents. Let's just call it 25 cents. Okay, so short strangle is when I sell an out-of-the-money call and an out-of-the-money put. That's not a great return based on the margin there, but everyone has different margin. I'm going to up this a little bit. Let's go to 55. and 75, just so it'll look nicer on the chart. That's a little better, a little bit better gap. So short strangle is essentially a naked call and a naked put combined together. You're selling an out-of-the-money call and out-of-the-money put. This is nothing against your strategy, William. I personally don't trade short strangles, short straddles, or iron butterflies. I will do neutral positions, but I do them as an iron condor, where I'd buy a further out-of-the-money put to sort of create a bull put credit spread combined with a bear call, because I don't want to have a naked call or naked put open and run the risk of a sudden unexpected movement on the position. Okay. Same thing, though, that we saw earlier with Arvind. When you sell the call, you have an obligation to deliver shares of stock that you don't own. The risk here for December 22nd at our 52 strike call, now that the stock is 52.54, or any time between now and December 22nd expiration next Friday, is we could be assigned and end up being short shares of stock at the $52 strike. Now, since we're selling both, we take in a reasonable premium. The margin requirement is something along the lines of the strike price of the put plus the premium received for the call, and then 33% of that total value. Different brokers have different margin and so forth. Okay, so what do we talk about with managing a short strangle? Depending on how much time you have left, William, and the reason for the stock moving against you, okay, would depend on maybe what you'd want to consider. So when we break down what we manage with spread positions, credit spreads, debit spreads, we've talked about this in other webinars. There's about 7 to 8 ways that we consider reasonable to manage a credit or a debit spread. Some of those are similar to manage a strangle. So number one, in this case, a week ago, Monday, maybe I sold the 52 call on AMAT and I sold the 48 put. My goal was to have the stock stay between those two strike prices in 10 days so that both options would expire worthless and I'd keep the 130 premium. Okay, now, what is one way to manage it? Well, what are the ways to manage it? Number one, the basic one right now is do nothing. Strong market today. Maybe I feel the market's going to pull back on Monday. If AMAT comes back down, of course, if it drops below 52, excuse me, my position's looking pretty good. Okay, so, you know, it also depends. If the stock's way up here, then I'm in trouble and I want to manage it. But if it's just a little bit above, do nothing. Maybe wait for a pullback, evaluate it on Monday. I'd hate leaving a long just for my personal stomach. You have more fortitude than I do, William, but just for my own personal sanity, I would not like to leave a short straddle or short strangle open over the weekend in a volatile market, which we haven't really seen yet, but the fear of headline risk is always in the back of my mind these days. All right, number two, treat it just as you would a covered call, okay, in this case, or a naked put. So the stock moves above your short call, we could buy to close the 52, right? And it's probably going to cost us a pretty penny, so it's going to take away from our credit or negate it, but then we'll sell to open maybe the 53 or the 53.50. If possible, keeping the same expiration date. But of course, if yesterday I was in this, let's say I was in this same short strangle for today's expiration and the stock gapped up to 52.54, naturally I can't stay with the same expiration. I'd have to roll it out in time. I'd have to roll to the December 22nd with further out of the money to help prepare the 54 or 55 cents it would cost me to buy back the short call, okay? But in this case, since I still have 5 days to go, I might buy to close the threatened option and just move it out, create a new strangle. Okay, so do nothing, roll the threatened option is number two. Okay, now let's take a look at that very quickly. What would it look like today if we did that with the current prices? So the stock's at 52.54. I want some more breathing room. Let's go to December 22nd. I'm going to buy to close the 52, and it's going to cost us about 106, 107. And let's go with the 53.50 for another 37 cents. Okay, so I'm keeping a short strangle, buying to close the 52. I'm not worried about the 48 put. That's looking better. All right, so now I'm going to go and sell to open the new one. Now it's only $59 maximum profit instead of what we were looking at $1.30, because we had to pay a debit of about 70 cents to complete this roll. but it's still a profitable spread, might not match your goals, but it's kind of turning a losing trade into a winner. You're just treating it almost like you would treat a covered call. How do I get more profit if the stock's going up above my short call? You roll the call up in price. How do I manage a bear call spread if the stock goes above the short call? You roll it to a different strike if you left room in between your short and your long in order to do that. It's the same thing here, move it out. Are there other options? Of course. One thing I could do is if I think the stock, my sentiment for the stock has changed and I think it's going to move up, I may be able to buy, let's say a 53 call for 51 cents. Okay, so it moved up just today. I've got 5 days remaining to expiration, roughly, if we don't include the weekend, of course. So I'm going to buy another call. What is this going to do? Well, it's sort of going to create a bear call credit spread, but it gives me a little bit more leeway and it caps the risk. Now, what would be better than doing the bear call in this case, because you see it moved up the upper break even slightly, but it caps the risk if it really takes off, so it's more defensive. We took in, remember, $1.30 originally for the net premium. Instead of buying the now out of the money call, adding a bear call spread, let's buy the in the money. So we'll pay more money to buy the 51 call, but now we've got a naked put and a bull call debit. So if the stock continues to go up, you can have a profit of $50. Depending on your margin, you may have increased your risk a little bit here because now you essentially have a naked put with a bull call debit spread, a very small premium. It's very small premium, of course, but if the stock continues up, remember on the short strangle, you're just having more and more and more loss. In this case, you've done it as a bull call debit spread. You could also add an extra put here, which would look the same thing in this sort of laddered spread profit and loss chart. But now if the stock continues to move up for the next 5 days, you'll realize a profit instead of taking a larger loss. If your sentiment has changed and you think the stock is going to continue to move up, you could just bite the bullet, close the short call. Okay? In this case, it doesn't work. It's close, but it's not that good. So if I pay 106, let's say, to buy it back, remember the original short strangle took in $1,300. Now it's only $24 profit, so you're still just in a naked put. But if that money is there, your sentiment's changed, you think it's going to go up, close the call and allow it to run. I think adding that extra call to create the bull call debit spread with the naked put allows you to double dip a little bit, and you could get a little bit higher return. And someone just commented in and said, well, you could buy 2 calls, right? So I could buy back my 51 call and now buy 2 calls as sort of a ratio. So I buy to close that and then buy to open another one. Now you're in a synthetic long stock position. If and only if you think the stock is going to continue up in price. Okay? So follow up here to okay, hold on one second. Follow up here on this Donald comments. And Donald, you have other questions I'm going to get to, but I have to jump forward to see the commentary on this discussion and then go forward. Donald says, to roll, do you buy your short and then sell again with later expiration and or strike? This is what I meant by depending on the time frame you have remaining and how far it moved up. Okay? And what I mean by that is I still have enough time here where I can keep the same expiration. The reason why I want to do that is, remember how I talked about the margin requirement that is commonly used by brokers, where you can enter a short strangle with that sort of 33 or 25% of the short put strike price plus the premium of the call. And it's because your broker sees that it's a true short strangle with the same expiration date. If you buy to close the call, and I now roll out to the December 29th 53, 53 call or 53.50, December 29th 53, what happens? I'm no longer in a classic short strangle. My broker probably won't see it that way with different expirations. Now they're going to charge me the margin for the naked put and for the naked call. So that might not work so well. Now, you could if you wanted more premium and more breadth. I showed just keeping the same expiration where we could still keep a profit. But if you wanted a higher premium, you could buy to close both. Close this whole short strangle for a loss and then open a new one on December 29th or January 5th to get a higher premium and a wider upper to lower break even. Okay, but if you have the time, I would say just stay there. Okay. All right. So, and Mark, I see your questions coming in. You're third in line here, so I do apologize. You sent in about two follow-up questions to your original question. We haven't gotten there to the line yet, so I'll get to scroll through all of your questions related to IV in a moment. Okay. Now, back to our original position. Another comment by William is, why not roll up the put? Because in this situation, you could move the whole spread if you wanted to, but why pay the commission to roll this? It's going in your favor. It's getting lower in price already. What's hurting you is the short call. Okay? That's what's hurting you. What you'd never want to do is, in this case, just roll up the put for more premium and hope the stock comes back down. No, I don't want to do that. I don't. It's a possibility, but it's more dangerous because if the stock keeps going against you, you haven't done anything to stop the loss to the upside. That's where your focus has to be, is closing the position or adjusting the leg of the spread that is hurting you the most. Okay, that's really, really important. So, you might say, well, I just want to roll the short put up. Now, we could roll that too for a better premium now that it's declined, but it's not going to stop the risk. You could move the whole spread, but you don't have to. Okay, just let this keep going to zero as you originally planned. If your sentiment's changed and you're comfortable moving, now that the stock's at 52, moving your 48 up to the 50 for a higher premium, and moving the 52 to the 54, to roll the whole strangle, that is an idea. That is another one of the management techniques you could consider. So liquidate the whole spread. Let's just do that. Okay, we could liquidate the whole spread. We're going to buy back both of these. Let me just add them back in. Buy one apiece. It's going to cost us $110. So we still have a 20-cent net credit, and this might be a bad example for our original position because this short strangle is still at a profit, even though it's moving against us. Okay, but now we keep 20 cents of the original $1.30 premium, and now let's widen our stance. We're going to go to 50 for the put, get another 8-9 cents, and I said 54 for the call. Yeah, let's do that, 54. Okay, so we sell these two again. All right, so now we've closed the strangle. We've kept 20 cents. We roll again. See that? $54. Nothing wrong with that. But remember, the other management technique I showed you of adding the bull call spread, adding the extra call, by buying the 51 call right now means you didn't have to pay the commission to close the strangle and reopen another. You just bought an extra option, one other commission, to create a bull call debit spread if the stock continues up, with the same profit as long as the stock was above 52. One transaction, one extra option. Instead of closing out the whole spread and opening a whole new spread, remember, just buying that to create that debit spread, buying the 51 call to create the debit spread, had the same profit as rolling the whole spread out, and you would have saved commission fees. Okay? Does either one of these solve the problem of covering the loss? No. See, that's the problem with just rolling to this short strangle out further, is if it keeps going up, you could still have to manage it again. If I just bought the one call at 51 and created the bull call debit spread with the naked put, it can keep going up. Now, I'm not taking advantage of the upside, but I still have a profit on the position of $54 or 0.5% based on the margin as well. Okay, so sometimes a lot of you have heard me in my credit spread webinars and things of that nature discuss the concept of when you're in a bear call spread, you want to focus most on the short option leg and adjusting the short option leg to keep you out of trouble. And the same thing is with the strangle, okay? But you can convert a position by just simply rolling it as we just did. But my argument on just taking a bear call spread that has been threatened and rolling it to higher strike prices, or taking a short strangle and just rolling to different strike prices, is that you were wrong in the direction of the stock. Your anticipation was that it would stay between the strike prices at the time, but it's going in a direction against you. So simply rolling it and creating the same new position that's neutral, if the stock continues to move up, if it keeps doing that, you're just going to have to manage again and manage again and manage again. So it's not being a neutral position at this time, it's going that direction, okay? All right, James, I'll get to your question in just a moment too. Okay, now, let's go, James, yeah, your line there. So there's Wayne's, RA's question, I'm sorry, and a couple more, okay. John's question. When deciding which put to buy for a radioactive trade, okay. Oh, real quick, I'm sorry, let me go over this again here with a short strangle. One, just review, do nothing. Okay. Number two, roll the threatened option. Leave the other one alone, just roll the threatened option, but again, that comes with the risk that the stock, if it continues in that direction, you'll have to adjust it again. Three, my apologies. Number three, we could buy a call if it's the call being threatened, or buy a put to create a directional spread. In our example, we showed buying a call to create a bull call debit spread or naked put on a stock that's moving up. Okay, that's essentially how the spread would break down. You'd now have a bull call debit and a naked put on a stock that's moving up, and we still had a profit there. All right, number four, could just close the leg itself. Close the threatened leg if it's still at a profit. Leave the other leg open as it's now more profitable, or just liquidate the position if you can still do a profit. That should have been number two, really. One is do nothing if you expect it to come back. Two is close the whole position if you can still get out with some profit. Three, roll the threatened call. Four, buy a slightly in-the-money call or in-the-money put in order to get the position that you want that can follow the direction of the stock. New sentiment. All right. And then, of course, we talked about number five is just number five is just closing the leg as well. You could roll the whole spread. As we saw, we could roll the whole spread to more strikes to increase the upper and lower break-evens, more in our favor. But again, if it continues to move against us, that's not what we want to do. What I wouldn't want to do is if the call is being threatened is roll the short put to try to get more premium, because I can buy this back cheaper and get a new premium at a higher strike, let's say at the 50 strike, and leave that 52 original call open. Because that's the put's not being threatened, it's the call that's being threatened. I have to manage the call. Okay. So that's just a quick review on some ideas on the short strangle movement. I know there are other services out there I've heard that try to manage straddles and strangles by what's called we talked about this 2 weeks ago, a straddle swap or a strangle swap, or even adding a long strangle to the short strangle, which would create sort of an iron condor, but I don't think that would give you what you'd want profit and loss wise. I think it'd be better with some of the ones I showed where even though you're taking away from the profit, you've turned it to a directional trade. But be careful when doing that. When we added that long call and sort of had a naked put and the bull call debit, which are both bullish, if AMAT pulls back and drops down to 49, I'm losing on the bull call debit and on the naked put now. So that's a risk. All right, so to the question, when deciding to buy which put to buy for radioactive trade, do you base it on your decision on how much risk the stock and put will cost, or are there other parameters to consider? This is John. Okay, based on the rules in the blueprint, the guidelines in the blueprint, okay, what we're looking at there is anytime I open a married put, I'm going to go at least 5 months out in time to take advantage of the time decay curve, the 3 core principles of radioactive trading. That's the red line. So I'm going to go at least 150 days out minimum. I don't want to go more than 20% in the money because then I'm hedged out of the position too much. You go too deep in the money, you have too low of a risk. You need the stock to move much further to realize any significant profit whatsoever, or if any profit at all. Okay, so you don't want to go 30, 40, 50% in the money, 7, 6 strikes in the money. I could buy a stock at 50 and buy a 75 put for $26 and have a $1 risk, which would be about 1.6%. My expectancy of profit is basically 0. So I won't see any profit until the stock's up around $73, $74 per share. And if that was my expectation on a $50 stock in the next 3 to 4 weeks, I'm using a different strategy than simply a married put. Okay, so we talk about the consideration there, 150, and of course your risk threshold does come into play. So what I'd say is my personal preference, I only want to look for positions that are less than 7.5% risk, and I'm not going more than 20% in the money, and I might actually lower that to 15, okay? But let's take a look. Let's narrow down our list. One more thing I'm going to do also, go into fundamentals, based on my account size. In the search tool, this is the same kind of criteria you can use for every strategy, but I'm going to limit the stock price to be around $75 per share, the maximum, instead of 200, right? Okay, now, here are some of the ones. I'm just going to take Auto Home as an example. Now, it shows me that on Auto Home, I could buy the stock for $61.23 and buy the 70 strike put for $13.20. So my true risk would be $4.43, or nice round 6% at risk. Now the search tool is put in with the criteria that Ernie and I would use when we open a new married put position. Once I see the position come up, of course, I'm going to look at the stock chart, the company information, news, profile, and more. I'm going to do my due diligence to make sure this is a married put I want. And one of the last things I'll do is go to the search by symbol tool from the search as part of my research. And this is going to take me to all the strikes that are available. This might not be the best example, okay? But the 70 strike for me is the one that matches my risk the best, the one that came up in the search. Why? Because it's within the percentage range I want, and it's got the maximum risk I want. Now the 65, with the stock at 61, would be something I would consider. It's got an 8.5% risk, which is outside of my personal bounds, okay? But when I looked at the stock chart and the company information, I felt that this was still in a strong move, and maybe in the next 20 to 30 days it'd be trading at around 65. I might take that extra risk, because if the stock moves up, in the next 2 weeks it's trading at 64, I'll have a lot of opportunities to do different income methods there to start cutting into that 8.5% in just a week or two, okay? This is more conservative. Why am I not considering the 75? It's a little bit too in the money, okay? It's $14 in the money, so it's on that threshold, a little bit above or just around that threshold of the maximum I'd like to see based on the rules in the blueprint. So I can get a lower risk by going to the 80. I could probably go to the 85 and get a 1.5% risk. That's great conservative, but now my expectancy of profit, since you're so hedged out with that deep in the money put, so you need the stock to be trading at 84, 85. Let me find a different position. In fact, I'm going to use AMAT. We're just going to go to AMAT. It is a married put I'm in right now. I've been in it for a couple months. Did really well for me and then completely turned with the NASDAQ decline that we've had over the last couple months there. Let me see. There's nothing in May. I forget the expiration series. Mine's actually in April. I won't show that. Oh, maybe we don't have anything out. I'll try August. Okay. That's all right. It probably has something. There we go. Perfect. The reason why I wanted to pull this up is because it offers 2.5-point strikes, so there's more selection. Immediately, when I look at the search by symbol tool for married puts, and I'm looking one stock at a time instead of the search, my eyes automatically go to this range. Why? Well, because that's the risk I had in there, that 3.5 to 7.5%. Ernie will go to 8 or 9. I typically don't like to do that. I mean, this is the at-the-money put. The stock's at 52, 54. The 52.5 strike for the July expiration, it's an 8.8% risk. I'm probably going to stay in this range. So which one's better, the 55 or the 57.5? 55 gives us 6.6% at risk. I'm sorry, there we go. Yeah, it gives us a 6.6% at risk. 57.5 is 4.9. Which is the best selection? Well, that really comes down to your expectation of the stock. What's taught in the blueprint is the CSCO model. What is your expectation going forward? Me personally, I'm probably going to take the higher risk closer to at the money, because if AMAT continues this move it had today, if it goes up another $1 on Monday and 20 cents or 30 cents on Wednesday, we're up another $1.30, we're at 53.80, almost at 54, I'll have opportunities already to start applying the income methods to lower this risk, maybe even lower than 4.9%. With a 57.5 strike, we've got a nice risk at 5%. It's still a good trade. Both of them are good trades if AMAT is bullish. Okay, if we're bullish on AMAT, which I kind of am. Which is why I'm still in that position. But again, it has a lower risk, but now the opportune time to start applying adjustments that make logical sense to get good premium and reduce the risk are going to be when the stock's trading at 56.50 or 57. Okay? It could get there soon, but it might be a little bit longer. I'm okay taking a slightly higher risk. So in general, you can see it play out here already on the chart based on what we've already put into the criteria. Now, I made that adjustment to keep it 7.5 because that's my personal threshold. And then we decided that these two are probably the best in the range. And again, no more than 2 strikes in the money or 20% in the money for the position. You go too deep in the money, there it is. We could go to the 67.5 put, got much lower risk on the position. But again, it's not there. Okay? All right. All right, now John says, thank you. It's clear now. Also, does having delayed quotes in PowerOptions greatly affect your decision? No, not really, meaning that because the radioactive trading position is more, not common, it's more slow moving, the delayed is perfectly fine. You don't necessarily need real time if this is most of, you're trading most of your account in the protected positions, the radioactive trades as well. I would recommend you at least need delayed data at a bare minimum if you're trading positions, I apologize, if you're trading positions such as the spreads, especially management techniques on the spreads, I'd suggest you go real time, especially if you're doing weekly spreads, using the PowerOptions tools for weekly spreads, you want the real time. I think delayed data is perfectly fine for the married put because you're not going to see the put bid-ask spread when you're opening a new position move that much intraday, even if the stock's moving quickly, okay? You might lose some intrinsic value on the put. If it's jumping around 2 points every 30 minutes, you might see some fluctuation, but in general, it's still going to be around that risk. One last comment here. Notice that in our criteria, we're not screening by anything for delta or implied volatility. In all the searches, you can screen by the exact implied volatility of the option itself, the hard number, or the percent implied volatility range. Where's the option's implied volatility now compared to where it has been over the life of the option? IV over HV ratios and IV over SIV, the stock's implied volatility index, all available in the search, all available on the option chain to select, and we can go into choose columns here, okay, for that information to select things such as the implied volatility or the percent implied volatility range. The reason why I'm here now is I want to click on gamma, theta, vega, and delta. Okay, just real quick. Delta is probably the most important for this example. But a lot of times investors will say, well, why aren't you using delta? Do you use delta for your married put positions? Do you use delta to pick which put you need to buy? And the answer is no, but I'm already using it. Based on the criteria, if you're restricting the positions to be no more than 2 or 3 strikes in the money to have a controlled risk on quality stocks, without even sorting by delta in my search, notice that all of the deltas are restricted. The lowest is, the lowest is 0.45 delta negative, and the highest is 0.56. So even, all right, lying to you guys, 0.57 to 0.45. So even without screening by delta, I'm already screening by delta with the other criteria. The same is true if you look at the covered call screens. The weekly picks of the day or the monthly picks of the day or even the initial values default covered call screen, some new customers will come and say, why aren't you using delta in your searches? Well, because we're already searching by delta even though we're not. Everything works hand in hand. If I look for a good covered call that has a reasonable premium of 3 or 4% return for a monthly and a reasonable downside protection of 5% on stocks that have good liquidity and good volume, my deltas are all going to be in a range. Okay, I'm going to be looking at the slightly out of the money deltas, 0.55 to 0.45 for the slightly more aggressive out of the money covered calls, and it's already set. And if I did the in the money search for the picks of the day, for example, then in that case, you're probably going to see slightly in the money, so you're already going to be restricted to a delta of around 0.6 to maybe 0.7, 0.75, but we're not using delta in the screens. Everything works hand in hand. You don't necessarily need to screen by delta because you're focusing on the risk, which by definition is determining whether you're going in the money, out of the money, and that determines your delta as well. And probability, if you're using a credit spread, is essentially screening by delta without screening by delta. So every little thing goes kind of hand in hand there as well. All right. Now, Donald's quick question here was, where do I find the real-time implied volatility, real-time IV information? Okay, well, it's all over the place. Okay, so I talked already about how I could go into that choose columns field in any search, Donald. So if you're in the covered call screen, and we open the search, well, if you're on the real-time service, mine's delayed right now, but if I'm on the real-time service, let's see, do I have it already selected? Nope. But in any strategy, when you go into choose columns, just as you can filter by those, which we already saw, I can select to view the implied volatility, just check the box. Further down, I can screen, by the IV-HV ratio, the implied volatility divided by the stock's volatility, IV over SIV, and the percent implied volatility range, showing you where the option's volatility is now compared to where it has been over the life of the option. So in addition to seeing that on the searches, in the column view, so there's all my implied volatility numbers for these different positions. In addition to that, if you're on just the option chain, you can also click choose columns and see the information. But let me show you something neat. If I go over here, of course, let's just take Snap. That was one of Sam's positions from last week. I'm going to look at the December 15.5 call. So I'm going to go to Research, and I'm going to go to Option Research. This will pull up all of the available data we have for the individual option. So on the married put screen, if I had clicked on that, it would show me all of the data I have for that put option. Here's all the data, bid point, mid, ask, last, current session high, current session low, last trade time, so on and so forth. The yields for the positions, the Black-Scholes and other Cox-Ross calculations. Down below on the research tool for the option is a graph. And the default graph shows you option bid versus implied volatility. Now you can customize this many ways in the sense that I can choose to look at delta versus option bid or delta versus implied volatility, time value, open interest, compare it to the stock price, the volume, so on and so forth. Now I can drag that chart over. So what this is showing me is the implied volatility, the entire implied volatility for this option, okay, since the option was released on the market. Now, is this graph updated in real time? No, but it gives you the entire history of the fluctuations since the option was released on the market, which looks like November 2nd, because this is the December 22nd weekly, so that would have been the 6-week cycle, 7 weeks cycle when it was released, okay? But at the same time, it's not real time. But if I'm on the chain, Donald, I'd be on the real-time subscription, and that's $120 per month. But if I'm on the chain, I can select to view those columns for the implied volatility, percent implied volatility range, and so forth. And on the real time, I can sit here and refresh the page every second if I wanted to, every half second, as fast as I can click the refresh button to see the applied volatility. It doesn't force the update to you, but you can see it right there, okay? All right. So that's where you can get the implied volatility. And the subscription info, we'll review it later. But our end-of-day service is $40 per month. The delayed service we were talking about is $60 per month. And then the real-time service is $120 per month. This had to increase because of the exchange fee increase. For us to redistribute real-time data, the cost they charge us now to redistribute real-time data has gone up about 3-fold in the past 2 years. Okay. So unfortunately, we have to increase our prices for those that want real-time because they're charging more for them. All right, still got a lot of questions here. We're going to get to them as we go. This one is the one from Mark. It's a great question. While we're talking about implied volatility, this is a good place to be right now. Where was I? Oh, sorry, there it was. Okay. But we'll go back to the chain in a moment. So the implied volatility relates to time value. Well, yeah, I understand what you're saying, Mark, but the implied volatility, of course, is more of an expectation of fear for an upcoming event, which inflates the extrinsic value, which is sometimes called time value. The reason I make the distinction is that some of other educators out there have made comments about me and taken it to task when I say the time value increases, in the sense of if I'm in a married put that we looked at earlier that's in the money and the stock moves up and that put now becomes at the money, I lost intrinsic value, but that value which is not intrinsic due to what's called the ATM bell curve will increase. But I wouldn't say the time value increased, I'd say the extrinsic value increased. And it's the same with implied volatility, okay? Meaning that when the implied volatility increases, not the time increases, the extrinsic value of an option increases. You don't gain time as you move forward. What you gain is extrinsic value because changes in implied volatility if your option goes from in the money to at the money as well. Okay. Now, you wanted to know, I'm just making that distinction real quick, but you wanted to know what is the published value on Greek's tables comparing IV for a day to expire 30 days, 60 days, and 120 days out. You say it's fairly comparable, but we know 4 times as long in time, 4 nonce, the stock may vary more. Well, it may vary less, okay? Let's take a look here. I'm going to go to a change for AMAT, and I am going to go to the historical chain. We're just going to look at the call chain to keep it simple. I've got my implied volatility selected. Okay, but we're going to go back in time. Okay, on the historical chain here, I'm going to go back to November 1st, I guess. Let me try November 1st. Okay, and I'm going to look at December 15th, standard expiration, which was 44 days out. Now, the stock is at 55.71. I should have gone further up. The stock's at 55.71. It's been declining, and you see your December series 44 days out around 0.34, 0.33, 0.37, and so forth. Okay. Now, let me hold this. I'm going to hold December and move out to April. Okay. Notice that they're actually lower further out in time. Why? Because at this time, I know this because this was stock I'm in, November 1st, earnings were coming up between now and December expiration, which caused the further decline on the position, plus the drop in the NASDAQ, that huge drop we saw in the NASDAQ, okay? Now, your argument is that the stock may vary more over the next 4-month period. Yes, but a lot of times the options that are further out in time are not going to be as affected as the near-term events. So that's why you see a lot of stocks will have a higher implied volatility in the shorter term because they're going to be more responsive to any changes in the short term, where these farther out options are going to lag. An event could come up in December that causes AMAT to drop from $55, $56 down to $50 per share. These December options are going to fluctuate in implied volatility. The Aprils will too, but not as much because a lot is still going to happen. It's going to settle down, then it might be affected again, then it's going to settle down, then it's going to cross another earnings. So this is going to move, but it's not going to move as rapidly as the near-term options, which are most affected by daily changes in implied volatility, the stock price, headline risk, headline news. Let's take a look again at AMAT. Let's just go to big charts very quickly. And I want to go to 1 month, 2 months maybe. Let's go to 2 months. Now, we just looked at the chain from November 1st when the stock was at 55.71. Okay, that was here. The crazy thing is, here's the earnings. I'm sorry, let me clear up the drawings for you there. Here's the earnings. It actually was a very positive earnings. It gapped up to 61, then fell. Here's the NASDAQ decline. Okay, so let's look at that. November 13th and 15th. Let me jot that down. November 13th and 15th. And December 29th. Wow, brain. November 29th to about December 5th, okay? Let's just take a look. And so this shows us movement, both positive and negative. Okay, so what happens, let's go to our historical chain again, keep our same months, try to. What happens on November 13th? A little bit before that earnings. What's affected the most? Well, the shorter term options, our December options, are going to be affected the most. Now, so let me go back to December 15th here. Well, actually, the December 1st series was the one that was affected the most. November 17th and so forth. The December one's there. See, these are still at 0.35, 0.36. The standard December weeklies are lower. And let me hold this again and add April. I apologize there. It didn't hold it for me correctly. There we go. So the Aprils are at 0.33, 0.35. Now this is right before earnings. So they're all in a mix together. Now let's go to November 16th, just after that earnings event. All right. Okay. Here we go. December 15th, 0.36. Look, it's climbing. 0.37, 0.36. Stocks at 57.84, up $2. And our Aprils, 0.31, 0.33. They're not going to be as affected. What's increasing is here in the short term. Now, let's go to that drop we saw starting around November 29th, really about November 30th or so. Let's go there. Okay, let's take a look. Still at 50, it's been dropping. It's at 52.77. December 15th, the near-term options, 0.33, not too bad. What's the April's at? Lower, 0.30, 0.301. They're not as affected with this near-term jumping around. The near-term earnings, the near-term options are going to be affected by that. Shifts into things such as the what we were looking at with the NASDAQ correction that happened. Let me go just to December 5th now, just a few weeks back in time. And we see that, you know, they're greatly going to be affected. They're up to 0.36 now, 0.37 for the December 22nd, probably to December 15th, 0.39, 0.40, 0.38, okay? But down here, 0.34, 0.33. Aprils aren't as affected as well, okay? I'm sorry, I missed a comment a long time ago there. I'm going to keep going here. I know there's some comments on this one. But Mark's follow-up question was saying the Greeks question differently. Why isn't the implied volatility much bigger for far-out options? Well, that's why. Because the near-term implied volatility is not a measure of time value. And they're not related. The correct term is extrinsic value. Now, naturally, the premiums are higher here, and they say that that's because you have more time. But it's not a function of implied volatility. Right? It's a function of the time to expiration of the option. So naturally, a 6-month out option is going to have a higher premium than a 2-month out option. But it's not because the implied volatility higher, it's because of the time. The Black-Scholes pricing model and most pricing models really take into account 5 factors to figure out the price of the option. And of course, volatility is one of them. But it's the underlying stock price. Naturally, an option on a $10 stock is going to be less expensive than an option on a $1,000 stock. Of course, the strike price of the option, is it deep in the money, is it deep out of the money, or is it at the money? The days remaining to expiration. Okay, so that kind of dictates to you, you know, if you're further out in time, you're going to have an inflated premium. Doesn't mean the implied volatility is inflated. No. It's more expensive because of the extra time. But we wouldn't say implied volatility relates to time. We just showed that. Those April options all had higher premiums than the December because of time, but they all had lower implied volatility because it's not a direct relation to what you're thinking of. Implied volatility really relates to extrinsic value terminology, not time value. Okay? So the stock price, the strike price, the days remaining to expiration, the volatility of the stock itself. 2 stocks trading at 50, 250 strike options that are 20 days out in time could be differently priced. Why? One stock moves more frequently, like Starbucks, than, say, IBM or something along those lines, okay? And then, of course, the current interest rates is the 5th one, all right? So that's why the implied volatility isn't bigger for forward options, because it's not really the same thing you're thinking about. It's a relation to the extrinsic value, and yes, an option 6 months out in time that has a higher implied volatility than a similar strike option 6 months out in time with a lower volatility, but with a higher volatility will have a higher price. But that doesn't mean that the options further out in time will have a higher implied volatility. In fact, it's usually lower because the most pricing is going to be affected are the shorter term options by any fluctuation in the market, in the stock, any news events. And the idea is that you'll see an increase in the implied volatility further out in time, but things will calm down over time as well. Okay, relatedly, how to convert or compare an IV for a 6-month days to expire to the IV of a 30-day. I don't look at it that way. I'm sorry, Mark. I don't compare it that way at all. And in general, it's also dependent on your strategy. So if you're selling premium and you're saying which is better, the 30-day out or the 6-month out option because of the implied volatility, the answer is always going to be the shorter term option. And that's simply because if I'm selling premium, I don't want to sell an option that's 6 months out in time because the option that's 6 months out in time is not 6 times the cost. I'm purposely lowering my annualized return by selling further out in time. The concept of implied volatility is irrelevant at that point because it's more a structure of a strategy. If I'm doing a covered call, I want to be 10, 15, 30 days out in time. I don't want to sell a covered call that's 9 months out in time because there's a high implied volatility further out, unless there's a major event that's known between now and then. Okay, that's what would happen at that point. Okay, all right, so that's just something to consider there in the relation to the implied volatility range as well. Okay. Oh, Arvind, I was looking here. Let me just get a second here. Okay, yeah, no problem, Mark. You're welcome there. That's just my thoughts on the implied volatility. The terminology is, I've been called out on it before during webinars by other educators in the options business. The gentleman that used to work with Brokers Express is good for kind of an acquaintance of mine. He's a really good guy. We had some fun times out at the options expos when they ran those many, many years ago. We were on a webinar together and I made the mistake of saying that the time value increases as the option goes from in the money to at the money. And he kind of looked at me and he said, no, you can't say that. That's incorrect. Time value never increases. The extrinsic value increases. The time value never increases. So he was right. He caught me on that. But a lot of times, educators, books, webinars that you might see, even sometimes on Tasty Trade or Tasty Trade TV or whatever, they'll refer to the extrinsic value as time value, and that's not accurate. When you're comparing options, as you just mentioned, Mark, and you're doing the right thing, don't get me wrong, but when you're comparing options that are 2 months out to 4 months out to 5 months out, you're comparing the linear time. But the problem is options aren't linear. And because of the fact the option that's 6 months out in time is not 6 times the cost of the near-term option, that's why you always hear that you want to sell month by month by month or week by week by week because you get a better annualized return. You'll get more premium. But if you're buying, like we saw with the married puts, I want to start buying 150 days out in time or more because I'm paying less per day because that option that's 6 months out is not 6 times the cost of the near term, and I still have a good return on that position as well. Okay? All right. Oh, I'm sorry, Arvin's comment. Before I get to your question, you've been very patient. I'm sorry, is it RA? Yeah, RA, you've been very patient. I'm going to get to you just one moment, and then we've got James, some comments from Sam, and a couple other questions. But Arvind asked, regarding Ex-dividend, where do I see that data? Okay, right on PowerOptions. There's the earnings announced today. Oh, I don't have it selected. It's one of these pods that you can select. You know, we have the webinars pod, your watch, market activity. Up here in the pods, Ex-dividends announced today. It's right there. So I'll just select that. Doesn't do us good because it's Friday. But there we go. We have NYMT, NEWT, and DIN. Now, on this page, we can now click the link here that says View More Dividend Announcements. So that's the page there. I could copy the link for you, but that's how you can access it there. And now you've got the dates, the ex-dividend date. Here are all the ones from 12/15. That's a lot. And then here's all the ones from Monday. BlackRock, Gladstone, Main Street Capital, Omnicorp, Avago, Douglas Dynamics, Pinnacle Foods. We're still at 12/18. 12/19. I don't know that one. Horizon Technology Finance, Seagate. That's an interesting one. Tupperware. Tiffany is on the 19th. Okay, so there's where you can see the ex-dividends. Now, also in the search, remember, if I'm searching for covered calls, and this will go to our next question, but if I'm searching for covered calls, in addition to screening for the earnings, either between now and not between now and expiration, on the search event, you can screen specifically for an ex-dividend date between now and expiration or between now and 1 week from now. I don't think any of these that are in this list are going to match it, but let's see it. I took the regular standard default weekly picks of the day, added in the dividend between now and 1 week from now, and nothing. Okay, so if I wanted to look at that more, get that better, let's just clear the filters, and I'll go to standard January to open it up a little bit more. And let's put in that return. I told 3% return, 5% downside protection minimum. Doesn't really matter too much, but I'm going to want some liquidity. Option volume today greater than 0, open interest greater than 50. I'm not even going to look at, well, I'll look at stock price. Let's say 5 to 100, narrow it down. And then again, we'll go ex-dividend date between now and 1 week from now. So I opened a wide search, just put in a few basic ones. Geez, maybe dividend-paying stocks really are that bad these days with the low volatility. Let's lower the return. There we go. Wow. Well, that one should have been in there, huh? 3% a return if assigned and 5% downside protection for the Hess January. This is not a recommendation or suggestion. Ex-dividend date on 12/15. So we just create a quick covered call search there where we have all the dividends coming up within the next 3 to 5 days. Okay, so we got the 12/15 in there. I apologize, we can't buy them now. Hess was today. But yeah, you've got your returns here, your downside protection, reasonable strikes, slightly in the money as well. Now, the reason why I did that was not only show you how you could screen buy at Arvind if you're interested in looking for those with the ex-dividend date, but this comes to RA's question. He says he's seen some who recommend covered calls using deep in the money calls for better downside protection, looking for just the premium and dividend income. They roll down the calls if the share price drops. I know they're still not covering catastrophes and they limit upside, right? Have you tested similar approaches? Yeah, and it's not great long term. I'll get the numbers from him. I apologize. Ernie did an extensive test. Now, you've heard me talk during the webinars that I've been testing and testing bull put credit spreads and those criteria and the bear calls from the vertical spreads in August and making sure they're still profitable long term, and they are. Okay, the bull puts, the bull call debits, bear calls are not, as you'd expect in this market. An only way to get a good or a reasonable return on bear call credit spreads is to go really far out of the money to where the premium doesn't make much sense with this upward moving market. Bull puts, bull calls have been the way to go. Who knows when we're going to switch, but we might switch soon. Okay, but Ernie did testing on this idea, and there's a twofold problem. So let's say that, for example, Hess moved up 98 cents today and they released their ex-dividend date, right? But let's say I got into the stock the other day at 43 and I sold the January 42.5 call with the ex-dividend date. And I did this on Monday or Tuesday, okay? Part of the problem there, and it's not necessarily a problem. Remember, this is a 3.1 return if assigned for 35 days. It would have been 39 days if I opened it on Monday. But even with a 1 month out, 2 week out, 3 week out series, if your option, your short call is slightly in the money on ex-dividend date, you run the risk of getting assigned. Is that a problem? No, because I get the full 3.3% return on the position, okay, if I'm assigned early. I don't get the dividend where I could call this a 3.8% return or 3.7% return because I was called out before the dividend was paid because the option was in the money. The owner of the option wanted to own those shares of stock so they could be on record and get the dividend. I miss it because I was assigned early. That's a possibility of what can happen with these positions, okay? Now, well, long term, selling in the money covered calls hoping for the dividend, you might find yourself getting assigned more often at or around the ex-dividend date early so you don't get the dividends, okay? And then, of course, you say, well, if the stock falls, you can roll it down. how often do good dividend-paying stocks show a reasonable decline where you have to keep rolling it down and you're just adding to your losses by following a downtrending stock? The answer is not often, but the true answer is not often, but you've got to be aware at any given time of what your risk is on a position and a strategy. This would have been a terrible dividend covered call play for 2017. From 32 to 18, you lost $14 on the underlying stock. You're not getting a dollar premium for the in the money or the out of the money, especially covered calls on GE month by month by month. In fact, you're only probably getting about 40 or 50 cents. So you had some of that loss, but you're still down in the dumps. Dividend wouldn't cover it. Okay? Could GE come back? Who knows? Other stocks did not do this year. But there are dividend stocks that did show a 30 to 40% decline this year from poor management, bad exposure, just things going wrong in their direction. This is one of them. General Electric, big monster, well-known, 32 to 18, 14-point drop. You would not have made that up with covered calls and premiums. You'd still probably be looking at a 10 or 11-point loss in this position. Okay? Now, is it conservative? Yes. In the money, covered calls on dividend-paying stocks, I would consider conservative. Is it a good approach? Earnings numbers did not reflect that. Okay? We do have some default searches for you to use. Go to covered call, click on sample searches. These are themed searches that you can use as a stepping stone. There's a broker and advisor recommended covered calls on ETFs. There's a dividends and in the money theme search and dividends and out of the money if you're more bullish and want to avoid assignments. Let's just look at dividends and in the money. Now this one is not related to the ex-dividend date. I don't have that filter in there where we're looking for the 1 day out for ex-dividend date, but you could add that in to get closer to ex-dividend date. But here you see U.S. Steel, Signet Jewelers, American Eagle, reasonable premiums for 25, 35, 40-day trades, reasonable percent of assigns for slightly in the money covered calls with a dividend, but most of these have just passed or they haven't announced when they're going to come up next. So you could customize this using that filter I showed you to just add into the fundamentals. We're also removing the earnings between now and expiration, which is tricky in this strategy, isn't it? That's a good catch I didn't think to mention. I don't think anything's going to appear here because of that dual filter. Why? Most stocks I trade, there's one, Pinnacle Foods. Most stocks that I trade that pay a dividend, the dividend is usually released a day or two, or the ex-dividend is a day or 2 or 3 days after the earnings date, or sometimes even the same day. So if I'm telling the system to show me covered calls on stocks that don't have an earnings date between now and expiration, but do have an ex-dividend date, it's filtering a lot out. I might have to take that out. But that brings up another point. You're trying to do a dividend play with in-the-money covered calls, which is advisable in the sense that it is conservative. You're giving up some upside premium. You might be looking at just a 1 or 2% return for a 35, 40-day trade because they have lower volatility. And you want to get the dividend or maybe get assigned early with the in-the-money call so you don't get the dividend, but you get the max return. But a lot of these stocks are going to have earnings right before that. So how in the money is 2 in the money? Here's the stock at 56. January 55 call for a 2.2% return with a dividend coming up on 12/18. Now what if the earnings were on 12/17 and the stock fell 12% and dropped down to $50 per share? Well, you hedged it $2.35, so you have a cost basis of $53.80. You'd get the dividend, okay, but you're still at a $3 loss. You got to be careful with the earnings with the covered calls, even if you're in the money for conservative. Now, am I saying Pinnacle Foods is going to drop 10% for its earnings, or that it many times good, strong, high volume, high market cap, good dividend and paying stocks, Dow Jones stocks or higher quality stocks, blue chip stocks, fall 10 or 15% at earnings all the time? No, they do happen. Do those type of stocks fall 50% in value in a bullish year where the market is going up, up, and up? No, but we just saw with GE, that happens, okay? So plan for that and understand it as well. And I know you are, but remember the dividends, not only the dividends, but the earnings come into play with that strategy. A large loss could be realized quickly if it moves against you, okay? Yeah, and I agree with you, Sam. I wasn't making it a recommendation, but I agree with you. Sam says, you know, stay away from GE. Kramer even said stay away from GE. They have too much to fix and a lot to fix, and they're doing it, but it's going to take a long time to fix. And I agree with you on that. And then, of course, you commented also, Sam, that fear makes the implied volatility swing and in the markets, and that's absolutely correct as well. James, that's where I was going. Okay, going back up to the top here. James has been patient. I believe you sent me an email earlier today that I answered, or was it yesterday? I'm sorry if I forget. James wants to know, if you have a naked put and the underlying starts to go down, can you use a bear put debit spread to counteract the threat of the naked put? Short answer, yes. Long answer, no, because it's capped. Okay, what do I mean by that? Let's take a look. Why not? Let's go to the custom spread tool. And let's go to GE. And let's go to December. And let's say 2 months ago, I sold the 20 strike naked put for 35 cents. Okay, let's call it 50 cents. Let's just keep the number simple. All right. All right, so simple naked put, 50 cents, looked good. But in the decline, the stock kept going down, and now here we are at 1782. Okay, but let's say when the stock was just starting to go below that point, James, let's say when the stock was right around maybe 20 or so. And let me take a look there. Where was, I know it wasn't that recent, but let's take a look. I want to see something here. Oh, it was a long time ago, but that's okay. It was right before this dip. So let's say right about here, long time ago. Not really that long ago, but let's say around October 24th, we sold this 20 put for December expiration, okay? And now the stock started to fall and started to fall, and then right here, it went down to 19. So it broke below, and that was on the 13th of November, okay? Why am I pointing that out? Let's go to the 13th of November. Sorry. Okay, let's just do this. I'll do it here. Let's go to the 13th of November for GE. I'm going to take a look at some of those put strike prices on that date. Okay. November 13th. Oh, sorry. There we go. Okay, and I want just the puts now. And I'm sorry, in our custom spread, we were looking at today's expiration that we sold for 50 that's in trouble. All right, but let's say that during that time frame, we had opened it earlier, much earlier. We had opened it earlier in November, James. And on November 13th, the stock was at 1902, which just suddenly breached below our 20 put strike, dropped $1.50 that day. So it was at 20.50, and we probably hadn't hit our mental stop yet, and we're hoping the stock comes back up. It comes back up, and then suddenly, oh no, it dropped down $1.50, and now we're at a loss on our put. All right, so I'm holding the December 15th 20 strike put. Could I have done a bear put debit with the 21-23 strike to repair it? Okay, so let's sell the 21. How would we do a bear put debit? I'm selling the 21 put for 205, let's call it, and I'm buying the 23 for $3.90. I'm sorry, $4. Oh, that's horrid. I went right at the money quickly. Okay, I'm going to have to use these two. All right, we're going to call it 210, selling to open the 21 at 210 and buying to open the 23 at 395. Not a lot of premium, but it's a bear put debit position. Oh, actually, I'm sorry, that's a really good premium. Let's see, $2 there, and buy that at, yeah. Okay, so here's what we're going to do. Let's go back to the custom spread. So on that day, November 13th, I would have done the, what did I say, the 21 and the 23. Okay, we're going to cheat a little bit. I'm going to sell the 21 now. I still have a naked put in place. We're going to sell this at 210. And we're going to buy the 23 at 395. This would be our bear put debit spread. Does it repair? Yes. to a limit. Okay? That's the problem. If it continues to move down as this did, you're still suffering a loss. Is it less loss now? Yes, because I'm getting the profit of the bear put debit spread to help that. Look at the lower break even. It's at 1935 with this new adjustment. It was at 1950. Yes, we only made 15 cents on the debit spread. But remember, the debit spread is capped. If the stock continues to move down, you're not getting it. What you want is possibly a strategy, James, to repair a naked put, where if your sentiment is changed, where you can still keep a profit to the premium to the upside, but might do something like this, okay? So where extended profits could be realized if the stock keeps falling. A bear put debit spread can't do that because it's capped. It's going to lower the break even of your naked put because you are going to be able to generate more premium if the stock continues to move down, but it's capped. So it caps off, and now the naked put continues to lose in price. It's not really a repair at all. So what is a repair? Well, for what you're trying to look for, James, it's that complicated back spread or ratio spread where I'm going to sell maybe the 21 again. Let's go back. My apologies. Sell the 21 again, buy the 23 for the prices I mentioned, which was what, 210, cheating there a little bit, and 395. But I'm going to buy 2. Now, actually, this won't even do it. I apologize. This won't even do it what we want because you already had a naked put open. I'm sorry, I didn't think about that. You already have a naked put open. And I'm not saying it's going to profit, but now you buy 3. So now you've got more of what you want if the stock keeps falling. Hey, look, you'd be at a profit today. But essentially, what do you have? You've got a bear put debit spread that you opened, 1 and 1. You've got another bear put debit spread with the 20 and one of the 23 and a long put position. Okay, so you've got 2 working bear put debit spreads and an extra long put. But now, of course, when, as Sam says, we're not saying it is, but if it recovers now and goes back up above 20, now you're in a loss, and you could have a significant loss on the position as well. That's not a good repair for naked put, in my opinion. If you think it's moving down against you and you want something that extends it, you've got to have a ratio on puts. What increases if the stock continues to fall? Okay. A better answer here, by the way, is, I'm sorry, someone just pointed it out to me. A better solution here, in this case, instead of doing the bear put debit spread, would maybe have been to buy 2 to create a bear put debit spread with an extra put if it keeps moving against you. Okay. So now we'd buy 2. And remember, this is on the 13th, so it's at 210. I'm sorry, December 5th, so it's at 210. And so now it gives you that profit you want. So now as the stock continues to fall, you can gain to the downside. But now this is doing this here. This is now a loss if it recovers because you've got the ratio 2 to 1. So instead of adding a bear put debit, you've created a bear put debit, which is something you might consider, okay, is creating a spread but not opening a 2-leg bear put debit spread on the position, okay, to protect the naked put. That doesn't really work. It only increases it down a little bit more. It doesn't give you that range that you're looking for there for the repair if the stock continues to move down, okay? All right, and a comment on this one is Sam says, naked put without a spread is the most dangerous trade. Well, if you had a naked put in something like UVXY, he says, you buy puts against it and you could have a good spread. Yeah, that's true too, okay? And yeah, Rajiv says it might consolidate, GE might consolidate soon. It might, but I'm not trusting it. It could have consolidated at other times as well. And Sam's reference, of course, if the stock keeps going lower. And Sam did mention the ratio spread, which where I was going. Now, James, just want to show you something real quick here. As we always do, we end up referencing our webinars page at least once. It's powerop.com/webinars.asp. Let me send the link to everyone there. And when you go here, you can click on Options Strategies. So there's various sections of the webinars page: Power Options Tools, Options Strategies, Concepts, where we discuss things such as the weekly options, managing a broken position. Here's our discussion on implied volatility, and of course Greeks and why you may not need them for certain strategies as well. But in the option strategies, James, scroll down just a little bit here, one of our older presentations, managing your naked put positions. Here again, like we do with the credit spreads, we discuss the 5 or 6 different ones, 5 or 6 different ways we look to manage naked put. I may just buy a put, as Sam mentioned, or buy 2 puts as a ratio to repair it, but I wouldn't just have a naked put and add a bearer put debit to repair it. That 3-leg transaction we saw, it didn't work. Buying 2 puts would as well. Rajiv, yeah, we still have other questions there. I haven't gotten to your question yet. I'm reading the comments that were made in relation to our discussion, then going back up. So your question, I think, is next or second to next. But anyway, James, go to the webinars page. It's a public page. You don't need to be logged into PowerOptions to see it. Just go to powerop.com/webinars.asp. and go to scroll down there on option strategies, managing your naked put positions. We discussed different ways there, including the simple to the more elaborate. And I think we discussed the ratio spreads as we were just talking about as well. All right, let's see here. Okay. All right, I'm sorry, good. That was James's question. There we go. All right. Oh yeah, I'm sorry. Earlier I had mentioned, Sam was in a stock position on Roku, and he just clarifying that he's not in the stock position really. He's trading it, and that's what I meant to say. I didn't mean to say you were in the stock. I meant to say you were trading against Roku. You were doing calls and put combinations, selling and going long as well. All right. All right. So there we go. Rajiv's question regarding CSCO. No, that's not what I want to do. I'm sorry. All right. So he says he bought 200 shares before earnings at around $33 per share. And once it reached 37.5, you sold 2 38 calls. Okay, so let's just say December 22nd. It's a little bit higher, 38 calls. I don't know what the premium is. Let's call it 25 cents, 30 cents. Let's call it 30. All right. Okay, about a 1%. Oh, okay, so yeah, now after the gain there, so about 30 cents, looking good on the covered calls. And observe CSCO keeps going up. During one down day recently, you brought 3 call 38 strikes for December expiration. What would be the best option to take this forward? You rolled the December 38 calls to the January 39 for 5 cents, okay? And your assessment is that CSCO will benefit from the new tax bill. Well, you've got all sorts of ratios going on here. You said December 17. I don't know if you meant the 15th for the 3 calls that you bought. And later observed CSCO keeps going. One day brought call. You did roll the December 38s to the 39s. Did you mean you just bought back those positions? You bought to close them and rolled them for 5 cents, or do you also have long calls? I'm not clear. Okay, because you're mentioning that you bought 3 calls, so I'm assuming that's a different trade. But you say December 17th. I don't know if you mean the 22nd, the 29th, and I don't know if it's really relevant. It kind of is, but let's see, 38 calls, because you can't buy 38 calls if you already sold 2 with the same expiration. So I'm going to go 28th and 29th. All right. And then, of course, you've rolled your calls to 39 for there. Oh, yeah, so you're kind of looking at almost a synthetic long stock position with this type of ratio. And you've rolled these calls for a higher premium, so you now have got the January 38s. And look at this of one of 2 ways. You can look at it as which you did. You have a covered call, 200 shares, 2 calls at 39 strike. I apologize, and 3 long calls. Or we could look at it as you've got 2, now, you've kind of got 2 bull call debit spreads with the January 39 and the December 38 calls with 200 shares of stock open and 1 extra call, however you want to look at it. long story short is even after you rolled this position, it's moving up. So you say, what is the best way to manage this position? Because you feel Cisco is going to have a big boost or will likely have a big boost from the tax reform. Well, I would stop rolling the calls or just close them. All right, you want to take extra upside, close the calls. You're worried about it falling? Buy a put. Okay. Now, I mentioned you already rolled these, so let's just put that in here. All right, 38. And this is one of those things to me where it's, I don't want to say it's an unnecessary complication, but you're you're rolling these calls, and you said that you rolled these calls. You bought back the 238s and sold the January 39s. You moved up a strike for 5 cents of premium. Okay, so it's cost you 5 cents. Let's put that in as 35, and then you got 30. Or maybe you meant in the case of this, with this 30 included, so you actually had to pay 65 to buy this back, whatever. Okay, but let's just look at that way. Okay, so it's still just a long stock position. You've got a good low break even, but if you want to see more upside, you want to see your upside doing this more instead of being shallow. What's causing that to be more shallow this direction? Your short calls. So if you're really that bullish on it, buy to close the short calls. Leave the stock and the long calls open. You're double dipping on a double bull move. But again, sure, the premium's okay, but if your expectation that the stock's going to keep coming up, eventually you're just going to have to let these be assigned or buy them back and keep rolling them. Why pay the money? If your expectation is really that you're going to go to 40, 41, 42, 43 on Cisco, just get rid of the short calls entirely. Leave the long calls you got, leave the long stock you got. That's your bullish expectation. Go with it. Okay? That's the most dangerous thing you could do, right? You know, that's the most dangerous thing that you could really do because it doesn't have insurance. So I would probably buy a put on this somewhere just to hedge it, especially if it's got earnings coming up between now and then, because the stock could benefit from tax reform. The stock could keep moving up, but if somehow its earnings disappoint, and I'm not saying it is one way or the other, well, then you get a 10-15% decline and you've given up that gain you've had from 33. Possible? Yes. Likely? Probably not. Look at some of the gaps we had here, back there. There's an earnings gap, right? Back in May or June, dropped from 34 down to 31, 3-point movement. So if it drops the 3-point movement, it goes down to 35. You're still in the profitable zone, but you've dropped that up. All right, there was the last gap. Here's one similar, is about 32.50 to about 30.50 there. Now we go back 2 years and 3 years and see that. But again, if you're planning for it to continue to go up, what's hindering your upside movement more? The short calls. Sure, they brought in premium, but they're hindering delta going upwards. You want that higher delta? Close the short calls. Otherwise, you're just going to keep rolling them. Okay? Okay. Oh, and James, you bring up a great point. Okay, sorry, going back to our question there, and I think, oh, and sort of Sam commented on that too. Instead of looking at the naked puts, you would do a bull put spread instead of doing a straight naked put. And you were thinking Tesla was one of the ones that you would do that on as well. Okay, but James, your comment was you looked at just buying the put to convert it to a spread, but it was just too expensive. That's why you wanted to do the bear put debit, of course, because you wanted to hedge the cost of buying the put by selling another put. But again, remember what the profit and loss chart looked like. Does it repair it? Yes, but only to a point. Whatever your profit is on the bear put debit spread by itself is the only amount you're going to hedge the loss on the naked put if the stock continues to move down. You still got to do something with that naked put position. Now, closing the naked put, taking the loss and opening a bear put on its own, if the stock continues to fall, could turn a losing trade into a winning trade. Okay? But again, even just buying the put by itself as the stock moves down might have been enough to turn a losing trade into a winning debit. Might not have been a lot of premium. Might only have been a 0.2 or 0.3% gain. But as the stock continued down, you would have had a profit instead of seeing a 9, 10, 12% loss continue to increase by leaving the naked put open by itself. Okay? All right. Okay. Let's see here. Sam's comment back to Cisco here is he says he thinks he'd buy a 40 put, and if the stock still goes up, sell the puts in the money. He should buy back the short calls in that scenario. in Cisco. Yep, that's what I was thinking of too. So I'd want to protect this now. Now this is where you stand right now. You've got shares and you've got calls. I don't know your price and I don't know what you paid for those calls, but I'd at least insure 200, maybe 300 of the positions with a put in January, February. I don't know if I'd go April. Let's go March. I would pick a put that at least goes through the next earnings date, whenever that is. I don't know when that is. I don't know if I want to buy 2 or 3. I think I want to buy a minimum of 2 there. Okay. And that would at least cover the stock position. Yeah, it's a bulletproof position. So you're guaranteed 10% even if it swings back, and you still got the upside. I would buy back the short calls you might have open now. I would look to insure some of this with a put option that carries you through the next expiration as well. Okay, and originally the stock moved from 33 to 37.5, and that's when you sold the 38s, right? And I'm not saying you sold the 38s are bad, but as it keeps moving up, just as we talked about earlier with the short strangle position and the short call being violated, it's the same thing here. If you want to see more growth and you're just rolling the calls, but your expectation is the stock's going to continue to move up, sometimes it's better to just buy to close the call, take a little bit of loss on that call, leave the upside open, and protect the gains that you have. Yeah. Yeah, Sam says the 40 trades and buy 2 puts. That's what we're showing here with this one. Locks in a profit of, even with the cost of the long calls, the 3 long calls, it locks you in a guaranteed profit of 10.9% even if the stock falls. It's a bulletproof trade going forward. And let's see when earnings are. I mentioned it 3 times. February 14th, good. So I made the right decision by March. I'd want to put that at least goes through the earnings event there. So you're guaranteed a profit of 10%, as we saw. You still have upside to go. And how could you increase this upside to make it less shallow of a graph, to make it look more like this? To get higher profits at these prices, you know? Well, that's easy. Buy to close the short calls. That's what's causing the shallowness here, is the 2 short calls in the position. Fantastic. Okay, I think that's the last of our questions. I do believe I got through all of them that came in. Mostly Sam's comment. He had mentioned he was in Riot too. It was a 25, mentioned the comment on Riot there, the 25 trade as well. For that position too. Okay. I just want to remind everyone, of course, if you haven't done so yet, what we saw today was using the PowerOptions tools. You can take a free test drive at any time. Just go to powerop.com, put in your first name, last name, email address. You get a free 14 days 14 days trial to test the tools on PowerOptions. The search tool we looked at for all the strategies, setting the ex-dividend date, fundamentals, technicals, and more, as well as that search tool for 23 strategies, but also the research and analysis tools, the graph of the options that we saw in the option research tool to look at the historical implied volatility, but also you can filter for that. And in addition to that, of course, too, we've got those portfolio tools we didn't look at today where you can track and manage your positions and evaluate rollout opportunities. And here we see review, again, what we talked about earlier, the subscription price is $40 for the end of day data, with access to most of the tools that you'd use for searching and analyzing positions. Delayed service is only $60 per month, about 15 to 20 minute delayed data, and then the real time is up to 120. We saw a little bit on the historical chain today, but you can also do historical searches, search by symbols. That's an upgrade of $40 on top of the delayed or the real time to get access to the historical service, which is goes back to April of 2006 as well. Remember, of course, you can check out our blog for other free information. Just go to blog.powerop.com. I gave you the link already to the webinars page. It's a public page. You don't need a PowerOptions trial or subscription. Just go to powerop.com/webinars.asp. You can go through our educational webinars. And remember, you can also check us out on YouTube at any time. Just go to YouTube, look for PowerOptions. You'll see most of our videos there also. All right, if you think of any questions later on, remember, just send me an email. Raj, I'm not going to be able to get to your question. I might email your response later today. It's already 6:15. I might email your response later this weekend, or we might just put something together for everyone, and that's talking about using a diagonal calendar on Disney for a bullish view. as before, just real quick, I'd probably buy something that's 3 to 4 months out in time in the money and sell a 1 or 2 strike out of the money call for a 2-week or 3-week period against it. That'd be my first structure I'd look at if it matched my goals as well. Okay. Just remember, you can call the market. You can call the office during market hours as well at any time. Okay. You can reach us there. And those of you that are on a trial or subscribers, remember you can schedule a coaching session at any time. Just click the link for coaching session. You'll see a schedule. Just schedule a time that matches your convenience as well. Okay. So yeah, Rajiv, I don't know how much time I'm going to have next week, so I'll probably try to do it for you this weekend, but I'll post it on a blog at PowerOptions for you. We'll take maybe a look at analysis on calendar diagonals, what I would do as a calendar diagonal on Disney with a bullish view. Okay, and then when I put it up there on the blog, all of you can comment on it and tell me what you would do instead. But I'll let everyone know when that's up there because I'm going to be doing a lot of several webinars next week. Not several, 2 or 3 webinars next week for radioactive trading. So I don't know if I'll be able to get something, or we can just talk about it next week as well with those there bullish diagonal spreads also. Okay. All right, Mark, thank you for your comments. Thank you for your questions. Sam, it's great to see you here. Rajiv, I'll get you that commentary there. Also on the diagonal spreads. Okay. Ladies and gentlemen, have a fantastic evening. Have a great weekend. We'll see you next week one way or the other. I'll let you know what's going on either by blog, by webinar, or we'll see you next Friday as well. Take care, everyone. Good night.